Hello and welcome back to Global Value. In today's video, we'll be performing a fundamental stock analysis of WingStop Inc., ticker symbol W-I-N-G, Wing. At the time of recording this video, WingStop is trading for $76.60 per share. 2020 has been a rough year for WingStop. Year to date, they're down 56%. Going back 1 year, they're down about 50%. Going back 3 years, they're down 20%. However, over 5 years, they've actually returned a 20% compounded annual return. And going back 7 years since they went public, they've returned about 13.4% compounded annually. WingStop is a little under $10 over its 52-week low, which is down quite significantly from their 52-week high. WingStop has about 10% of its shares outstanding sold short right now, and WingStop is a $2.3 billion market cap at the time of this video. So what does WingStop do? WingStop Inc., together with its subsidiaries, franchises, and operates restaurants under the WingStop brand name. Its restaurants offer classic wings, boneless wings, and tenders, as well as the newly added thighs that are cooked to order and hand-sauced and tossed in various proprietary flavors, which range from extremely hot to mild, atomic, mango habanero, Cajun, original hot, Louisiana rub, mild, hickory smoked barbecue, lemon pepper, garlic parmesan, Hawaiian, and teriyaki. As of December of last year, the company had nearly 1,700 franchised restaurants and 36 company-owned restaurants in 44 states and 7 countries worldwide. WingStop Inc. was founded in 1994 and is headquartered in Addison, Texas. We'll be performing a modified 8-pillar analysis as popularized by Everything Money, taking a look at 8 different key financial metrics of the business and coming to a holistic and beginning understanding of WingStop based on its financials. Let's get right into this saucy bad boy. Starting off with pillar number 1, we want their average 5-year PE to be below 22.5. So WingStop's current PE is 60. The lowest their PE has ever gotten during these last 5 years has been 45. And they've traded at an average of 113 times earnings. This is kind of a rough X to start off. Pillar number 2, we want WingStop's average 5-year return on capital to be above 9%. So WingStop blows this metric out of the water. They average returns on capital of nearly 39.5%, which is more than 4 times that 9% metric we're looking for. Over the course of decades, the approximate return that you'll earn on a stock is going to be about what its underlying business is able to earn as a return on capital. So because WingStop is a franchisor, they're able to have these higher returns on capital. And so even though this is expected, it's still really great to see. This is a big check on pillar number 2. Pillar number 3, we're looking for 5-year revenue growth. WingStop has grown revenues from $133 million in 2017 to $282 million in 2021. So they've doubled revenues over this time period. Pillar number 4, we're looking for 5-year net income growth. WingStop has almost doubled net income over this time frame. They had about $24 million of earnings in 2017, and they had about $43 million of earnings in 2021. So 3 checks in a row from pillars 2, 3, and 4. Pillar number 5, we're looking for decreasing shares outstanding. When you purchase a share of stock in a business, what you're really buying is a fractional ownership percentage of the underlying business. When a business dilutes existing shareholders by issuing new shares, they're lowering your ownership percentage of the business. Ultimately, what that means is they're lowering the percentage of the business's profits that you're going to be entitled to now and into the future. So we don't want a business to be issuing new shares. WingStop has slightly diluted shareholders throughout this time, but very marginally, just adding a tiny amount of about 500,000 shares when they have 30 million shares outstanding. Even though this is going to be an X on pillar number 5, this one doesn't bother me too much. Pillar number 6, we're looking for 5-year free cash flow growth. Free cash flow is cash from operations minus capital expenditures. It's this column here in green. Free cash flow is the lifeblood of any business, and a business's ability to produce free cash flows now and into perpetuity is ultimately how a business should be valued. So WingStop produced $25 million of free cash flow in 2017, and they only produced $21 million in 2021. So pillar number 6 is going to be an X. Even though they increased their cash from operations over this time frame, they significantly increased their capital expenditure in the most recent year. So it looks like in 2019 and in 2021, WingStop put a lot into CapEx, which lowered their free cash flows relative to these other years. In these other years, they haven't spent as much on CapEx. So one thing when learning more about the business is we're going to want to understand these capital expenditures in more depth. But that's an X on pillar number 6. Averaged out over these 5 years, WingStop produces about $31 million of free cash flow in an average year. So we'll use that number when we evaluate the leverage that WingStop is taking on as a business, and then how their current market cap compares to their free cash flow. Pillar number 7, we want their net debt, which is long and short-term liabilities minus cash and short-term equivalents, to be below their average 5-year free cash flow multiplied by 5. So at the end of the year last year, WingStop had $437 million of net debt. When we multiply their $31 million of average free cash flow times 5, that only brings us to $155 million. So that's an X on pillar number 7. WingStop is taking on more leverage than we'd like to see in a business. This does make sense that they're taking on higher debt as a franchisor. However, looking at some of these other franchises, like the Starbucks franchises outside of the United States, and then Domino's Pizza, those businesses are also using higher levels of debt than other companies, and they're able to earn very high returns on capital as well. So although we don't like to see it, and this could potentially be an issue for WingStop, we can look at their 10K and understand how this debt is structured and some of the unit economics of how they're opening stores to see if this really is excessive debt for the business or not. So again, that's an X on pillar number 7. The last 3 pillars have all been X's. So after we had some good momentum through pillars 2, 3, and 4, we're currently 3 for 7. Let's see about pillar number 8. So finally, the big pillar of them all, pillar number 8, we want WingStop's market cap to be below their average 5-year free cash flow multiplied by 20. So WingStop currently has a market cap of about $2.3 billion. When we multiply their average 5-year free cash flow of $31 million times 20, that only brings us to $620 million. So quite a bit off from their current market cap. So that's going to be an X on pillar number 8. Finally, let's look at WingStop's dividend profile. Ideally, we want a business to be paying less than 60% of their cash flows as dividends to shareholders. The column in blue is WingStop's regular dividend, which has increased each of these last 5 years. Free cash flow is this column in green. And then WingStop has also issued these special dividends per share in 2020, 2018, and 2017. So these special dividends have all been well above WingStop's ability to produce free cash flows. And in some of these years, especially the years where WingStop has had higher CapEx, their cash flow per share has just been able to pay their dividends. From an ownership perspective, again, without fully understanding the unit economics of WingStop's franchises and WingStop's businesses, at this stage in their business, I would actually prefer that they wouldn't pay a dividend and especially wouldn't be increasing their dividend or paying these special dividends. I would rather that they would put this money into paying down their debt and really stabilizing their balance sheet more fully. This is something that in doing further due diligence on the business, you're really going to want to understand how management is approaching this mindset of capital allocation. So in summary, WingStop checks the box on 3 out of 8 pillars. They're able to earn high returns on capital, but relative to our valuation metrics and relative to their ability to produce free cash flows, the business looks expensive. This type of analysis is just a holistic and beginning understanding of the business. This is not any sort of financial advice, and it's not a recommendation to either buy or sell the business. If you're interested in learning more about WingStop, I highly recommend looking through the company's filings, dive into their 10Ks, really understand their debt profile, understand how management is allocating capital, learn more about the ins and outs of the business. That way you can truly take on this ownership perspective if you're interested in buying WingStop. With that said, that's it for today's fundamental stock analysis analyzing WingStop Inc., ticker symbol WING, Wing. If you enjoyed the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about WingStop with me, and have a deliciously saucy day.